we ought to at least share some of these common strategies you might see out there on TikTok, Instagram, or other places, so that you can actually know how does this fit into your portfolio and your investment philosophy.
And so what we've done is we've tried to go grab some of the most popular ones. And the first one we're going to talk about is one that if you are in investing circles and if you've been investing for a while, you've likely come across this. It's this idea of factor investing. Now, factor investing is just a process of choosing investments based on specific factors that are believed to be associated with higher returns, such as smaller stocks or those that are undervalued when you look at the PE ratio. Here are some common factors that people think about: company size, growth, valuation, profitability, historical performance, leverage, liquidity, momentum. It makes me think about, Brian, I'm not like a huge sport. I like watching sports, but I've got those buddies that they're all into recruiting and they will look at specific attributes. Oh, this guy, man, he's got an arm and it's a cannon, or this guy, oh, he can shoot threes. It's kind of like selecting your investments with that. What's the special thing that this holding can do that because they can do that, it's going to outperform long-term? And because there's some unique trait about it, it's going to be a factor that's going to lead to better performance. And I think a lot of people are thinking of looking into that super deeply.
Well, I got to think, because you laid out like fantasy football, you laid out sports and other things. Surely there's more to this than just the gut feeling that this month we're going to focus on momentum, or this month we're going to focus on liquidity just because the banks are struggling. I know there's research and there's other things that have gone into this. Can you give us a little deeper dive on that?
Yeah, so factor investing is popular because we go through economic cycles where different types of assets perform better than others. Here's a really, really easy example. If you look at the last 12 years, and you're just looking at U.S. large cap companies, and you picked growth as a specific factor that you're going to utilize, U.S. growth companies, or U.S. large cap U.S. growth, has outperformed large cap U.S. value to the extent of 400% relative to about 265%. So if that were a factor that you had honed in on for the last 12 years, you would have outperformed. You would have been pretty happy about that. But you can see pretty clearly, if you were someone who thought value was going to be the factor that you should lay onto, maybe you would not be quite as happy as those growth investors.
But the question I have is, because I see this, and we see large cap growth, value. I know also, the data started here in 2010. We'd come out of the Great Recession before this, where we had the boom, and obviously so much has gone into innovation, and we'll talk about that when we delve into dividend investing and so forth. But I know that people, when they're talking about factor investing, it's not typically just large cap growth versus value. There's a model. And I like to say FF3, and we're not talking about Fast and Furious Tokyo Drift. What is FF3?
Yeah, so there were two University of Chicago professors, Eugene Fama and Kenneth French, that developed the Fama-French three-factor model. And what they did is, using specific research that they had conducted, this was back in 1992, they found that if you could look at company size and historical performance, and then book to market valuation, and you just focused on those three factors, and you selected companies that satisfied those three factors in a specific way, you would be likely to pick outperformers moving forward. And so, according to the Fama-French model, you look for smaller companies that were undervalued, that means lower price to earnings ratios, that historically had outperformed the market. So there was some momentum behind these companies. And while that sounds great, if you actually look at this, let's play this out practically. If you're looking at small companies, low PE, that historically outperformed, you guys have seen this illustration a lot. This is the Callan periodic table of returns, and it shows a number of different asset classes, and they're all color-coded. And this shows the last 20 years, from 2003 all the way till 2022, and how each of those asset classes performed relatively. So you can kind of see how the colors bounce around. Well, if you were to implement this Fama-French three-factor model, you would have had the green line performance. And what you can see is it's kind of like an EKG. It's like way up and way down. And there are some years where those specific types of companies were really strong performers, but there are other years where maybe they didn't perform as strong. It's this pretty volatile ride. Well, when you lay over that, just the broad market, just looking at U.S. large cap equity, the boring market that we think of, S&P 500, you can see that from a trend standpoint, it kind of moves in the same direction, but it's much more compact. The yo-yo string isn't as long. And so the question becomes, you just implemented this famous French three-factor model over the last 20 years. Would you have been better off because of it? Would the factors they pinpointed have been the ones that actually caused you to outperform? And it's really interesting. U.S. small cap stocks over that time period performed about 9.4% on an annualized basis. U.S. large cap performed 9.8%. So the large cap companies, the boring old market, actually outperformed. And what I think is wild is for most investors, that ride would have felt so much smoother. From a psychological standpoint, you wouldn't have had these wild ups and downs like you did in the small cap portfolio.
So we'll get to this a little bit later when we talk about the money guy flavor on how you actually bring this into your investment philosophy. But what I find interesting is that when people go all in and they say factor investing, I look at a chart like this, I think of modern portfolio theory where I don't want it to be an either or. I actually like both of these. I like small cap investments in my portfolio. I like large cap investments. Why don't we do and instead of either or? And that's something that's very interesting. But I love the thought that when, like I said, when academics and researchers and others get together and they are trying to come up with a better mousetrap, I'll just be curious to see if this is the way you should actually implement your investments.
So if I'm someone out there listening and I'm hearing this, I'm probably asking the question, well, why do people do this? Why do people do factor investing? Or if there are these really smart professors who say this is the way to do it, why don't people do that? Well, it's kind of in line with what you just said. Not all factors or segments of the market offer the same risk-adjusted rate of return. If I pull off the chart, if I pull off the lines, and I just show you this chart again, and you just kind of like zoom out, it's probably so small you can't really read it. But if you look, it's not uncommon for some segments to be top performers, and maybe even top performers for a number of years. But then you find that in the very next period or the very next group of years, they're underperformers. The one that I like to point to is kind of like that yellow, orangish emerging markets. There are seasons where if that's the factor that you're honing in on, you're going to feel like you're a genius. You've got it all figured out. But then there are seasons where if that's the factor that you're trying to hone in on, you're going to be like, what in the world did I do? Holy cow, how could I have been so wrong? And you said it best, Brian. I don't think that when it comes to factor investing, I don't think it's an either or. I think it's a both and in terms of how we do factor investing.
Well, I don't want people to be reactive with their investments. It's just like right now we know there's turmoil in the banking sector.
Yep.
So you heard us say one of the things you could focus your factor investing on is liquidity. So a lot of people might be thinking, hey, let's go ahead and run a screen where we pull out any type of things that struggle with liquidity, cash, and other things because I want to protect myself from any type of volatility of that. Well, the problem with any of these plays is especially if you're reacting to the current events of the financial world, you might be missing out on because the opportunity of a lifetime. Because a lot of times people, the maximum market opportunity to invest in something is when everybody else hates it.
When they're running for the exits.
I mean, and that's the part that I get nervous about is because you look at in the past, like with the Great Recession, if you ran a screen to make sure you excluded different sectors, like the financial sector after the Great Recession, or maybe after the dot-com boom, if you ran a screen to exclude technology from this, you might be getting yourself in a pickle in the long term because some of those components that seem desirable or least desirable at the time might turn out to be your best performers over the 10 to 15 year long-term window. And that's just something that I'm not a load up on one strategy. I'm more of a diversifier.
And so what's our flavor when we think about factor investing? Well, factor investing in the academic sense relies upon the belief that future performance of a stock or of a holding can be determined by historical quantifiable factors. Well, we all know if you've ever watched anything investment related, there's always this disclaimer. Past performance is not indicative of future performance. I just don't know that it works so cleanly. Just because something was the top performer yesterday does not mean that it's going to be the top performer tomorrow. And so when you really boil down into those that are like true blue factor investors, like they are picking factors and betting the farm on it, it's really technically a form of active investing.
Yeah, and you see people run concentration strategies and so forth. I always get nervous because I've told you guys I believe in the great big beautiful tomorrow and the law of accelerating returns and innovation and disruption, and there's going to always be ways for you to invest and take advantage of this ever expanding economy. And look, that's not just off of a feel-good feeling that the world's getting better and I'm a natural optimist. It's also because when you look at the performance of the large cap investments over the last 10 years, 93.1% of active managers underperform just buying the index. Right. So there's a lot of calories being spent, a lot of energy trying to figure out the next big mousetrap to get ahead of the curve and everybody else. When I'm just telling you, guys, we live in the greatest time with the greatest innovation. Just buy the market and you're going to be rewarded for it.
Yeah, I think you said it perfectly. Factor investing, in our opinion, is not so much an investment strategy as it is a portfolio design tool. Because when we design portfolios, we're all trying to think about what factors do we want to utilize. Are we going to invest in large companies or small companies? And how much are we going to do that? Are we going to invest domestically or are we going to invest internationally? And how do we decide how to split that up? The real gripe that we have with factor investing, and specifically those folks who are out there touting it so strongly, is how granular you get with the factors. Like, I'm just going to invest in this very specific set of companies. How hard you really bet the farm on any one factor because you feel like you have it figured out, and how confident you are that the factor that you have uncovered is the one that will deliver future performance. Because what's really, really frightening is that statistics and numbers and graphs and charts can be a little misleading. And if you don't believe us, look at this chart right here. This chart shows an overlay of the consumption of margarine from the year 2000 to the year 2009 and the divorce rate in Maine. And what you would be able to conclude from this illustration is that so long as less margarine is being consumed, people in Maine will be getting divorced less. Just because something is correlated, just because something can move in tandem, doesn't mean that there's causation associated with that. So just because you uncover some factor that did perform well, or two factors that are related that performed well and were highly correlated, does not mean that one caused the other. So I think people can arrive at very misleading conclusions when it comes to factor investing.
Yeah, I just want you to be open to expanding your toolbox to where you're not just a hammer looking for a nail, that you will consider, using large cap. Mm-hmm. You will consider using small cap. You will actually broaden beyond just where the factors that at the moment might be yielding good results, but over the long term are probably going to moderate and reversion to the mean, mm-hmm. as we like to talk about. So don't get caught up in those trends, the hypes, the other things, when it just might. It's not saying that factor investing is wrong, but it's probably just one component mm-hmm. of a much bigger thing that you're doing with your investments, with your asset allocation.